Hello and welcome to episode 483 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm good, Andy. I'm really excited actually about the social stuff that we're doing, YouTube, Instagram, TikTok, because we're having quite a bit of success. And in the last week or so, we've actually gained quite a lot of subscribers on our YouTube channel, thanks to this podcast actually, because there was a part of the podcast that we repackaged that proved incredibly popular on pensions, but we've done other bits as well. And actually, we've created some unique pieces. We're always creating unique pieces for the social channel. And another one that was popular was when I went to the local supermarket and got a Too Good To Go bag. For those who don't know, it's an app that enables you to get food that's going near to or it's at its best before date. And rather than the shops and supermarkets throw it away, the retailer will actually sell it to you for about £4. And I put on social media the haul that I got. You get a bag and it could be absolutely anything in it. And I end up having steaks and sea bass and sausages and all sorts of things in there that I could freeze, all for £4. And it was probably 10 times that in value in my particular bag. And that was very popular on social media. So if you want to see all the other stuff we're doing beside the podcast, then do make sure you go to our YouTube channel, Instagram, TikTok, and subscribe because there's so much content on there. So having mentioned the podcast, Andy, I've got a slight confession. I'm moonlighting next week. So I will be on our podcast as usual, but I'm going on to another podcast I've been asked to go back to. I'll tell you a little bit more about that in these coming weeks, and obviously we'll share that particular episode. I'll give you a hint, it's in relation to pensions. But yes, I'll be back next week, Andy, but I thought I'd just tell you that before you found out and got upset.
I wouldn't get too upset. I like you spreading your wings. It's nice to see you on other podcasts. And it's nice to see how they edit you and see if they can do as good a job as me. Anyway.
I have to say, Andy, you do such a brilliant job, because on our YouTube channel, one of the videos we released, people are saying, well, Andy's not doing much in that particular clip. And I think people realise, they were saying it's slightly tongue-in-cheek, but the podcasts and videos wouldn't actually exist in the format that they do without Andy editing them. Actually, I'm laughing there, Andy, because I've done that 3 times. I'm going to leave that on the podcast, actually. I just did that 3 times, and Andy's going to have kept in that final one where I got it right. But Andy edits the podcast and makes me sound coherent. So that is brilliant. One thing before we move on to what's on the podcast this week, Andy, reviews. We keep saying we're going to read them out. I'm not going to do it this week because we've got another packed show. We'll probably do it next week. So if you haven't put a review on the podcast, whether it's via email to us on your podcast app of choice, make sure that you do it. We're going to be looking for them, and I will be giving away Money to the Masses mugs. So it's a bit of a warning. Get them in, because the next wave of mugs will be awarded fairly soon.
So Damien, just before we move on to what's coming up on the podcast, I do briefly want to mention Spotify as well, because Spotify, people who already use it will notice they've made changes in recent weeks. They're investing a lot of time and effort in helping creators like us promote the podcast and push it out to more listeners. So we're going to embrace that. We've got more stuff coming up on Spotify. And in fact, we're going to put a poll out on this week's podcast. And anyone who listens to the podcast on Spotify or wants to, please do take part in that poll, because it will help to spread the word about our Money to the Masses podcast.
And one final thing before I tell you what's on the show this week, don't forget the Instagram quiz that's out every Sunday/Monday morning. 5 multiple choice questions on the topics covered in this week's show. So on the show this week, Andy, I'm going to be doing the 3 pieces as normal. The first piece I'm going to do is in relation to investing, and in particular Donald Trump. So Donald Trump is now going to be the new US president, and as a result there's been some significant moves in investment markets, like stock markets, bond markets, commodities, and we are seeing the word Trump trade bandied around again. So I'm going to look at what's going on. Can you take advantage? What could happen in the future if we look at the lessons of history? Then I'm going to do a quick piece on pensions. So we had the autumn budget just a few weeks ago, and there were quite a lot of people who anecdotally took money out of their pension ahead of that because they were concerned about there being limits on the amount of tax-free cash that you could take from your pension, for example. And now, obviously, we know that there wasn't any changes to rules regarding that particular aspect of pensions. And now some people are wondering what they should be doing and if they can even reverse what they've done to their pensions. So I'm going to be telling people what you can and can't do and things to watch out for. And actually, the time is almost up on certain actions that are still available to you. And the final piece, Andy, you're going to be covering is in relation to energy.
Yeah, that's right. So I'm going to be talking about the recent energy price cap figures that have come out. Average bills are going to go up about £21 a year, but what does that actually mean? How does that compare, say, to this time last year? And is now really the time to consider fixing if you haven't already? We'll be doing that at the end of this week's show. Okay, so let's move on to the first piece of the podcast, and it's an investing piece. We're talking Donald Trump and the Trump trade. Damien, what we got?
So if you go back to 2016 when Donald Trump last won the US election, and there was a massive move in markets back then. It was dubbed the Trump trade. Now, if you fast forward to 2024, we've seen something very similar in markets that's now being dubbed the Trump trade 2.0. So I want to talk about that and actually give some insights as to what is happening, what might happen, and whether you can take advantage. Now, this part of the podcast has been inspired by a new piece of research for 80/20 investor members, which you can go and see in full if you take out a free trial. I'm going to give you some highlights, but if you want to know the full details and the facts and figures, then go and look at that piece of research for all of that, because I'm only going to be putting up on screen, if you're watching the video version, a couple of heat maps that you can look at, but just to give you enough steer as to understand what is happening in markets and what might happen going into the near future and over the next 4 years when Trump is in power. Now, going back to 2016, if you recall, Trump came to power on promises of tax cuts, infrastructure, spending, building walls, and it had a huge impact on markets. There was the assumption that we were going to see plenty of inflation, economic growth. That started to impact the way that investors were allocating their money. In particular, we started to see a rotation from bonds into equities because they tend to do better in a growth environment. And in a growth environment where you've got inflation, then bonds tend to be less attractive. We also saw sector-specific gains. So, for example, back in 2016, we saw financial surge because of that promise of deregulation. We also saw industrials and materials and infrastructure do very well. So we're looking at particular sectors within the S&P 500 that's the US stock market. They outperformed. Things that were slightly more defensive, like consumer staples, utilities and real estate, they lagged because they are that bit more defensive. People are moving into more growth and economically sensitive sectors. We also saw the US dollar strengthen, and that had a big impact. If you get the US dollar right, that direction of travel, you tend to get the direction of travel of most assets right. So for the US dollar to strengthen, that has a general negative impact on emerging market assets. So you tend to get movement of money back into dollars. You tend to see things like Asian equities or emerging market equities tend to do pretty poorly in that environment. You tend to see Japanese equities do well because the yen weakens against the US dollar, which is positive for Japanese exporters. And those market moves played out in the weeks after the US election back in 2016 and ahead of the inauguration date on the 20th of January 2017. So what's happening in 2024? Well, there is a definite Trump trade 2.0 that's occurring. So if you look on screen, there is an image of the S&P 500 over the last few weeks since the US election result. And if you see in the first days after that particular result, the S&P 500 surged over 5%. It's pulled back slightly, but it's still up around its all-time highs. So if we look at the best performing assets globally since the US election, then you will see that the top performing unit trust sector is actually the North American smaller company sector that's up about 7% in just 2 weeks. That's followed by financials, that's up about 6.5%, and then North American equities, technology stocks, global emerging market, hard currency bonds, Japanese equities and global equities. Just to give you some insight into the reasoning behind those surges is the whole Trump Make America Great Again is obviously seeing US equities surge and the whole prospect of economic growth. Financials have surged because of the hope of deregulation. So that happened in 2016, the hope of deregulation that saw financials surge. We're seeing it again in 2024. Funds centered around technology stocks are doing particularly well. They will include things that have, by association, performed well because of Tesla's surge. Obviously, Elon Musk is now Trump's best friend. And the emerging market hard currency bonds, that will be because of the rise in the US dollar. So they've become relatively more attractive than other global emerging market bonds in local currencies. Japanese equities there, they've surged because we've seen the yen weaken against US dollars, I've mentioned already. And global funds is because they are about 60% US equities on average. So that's why they are doing well, because US equities are doing particularly well. Now, if we move on to the worst performing markets since the 2024 US election result, you will see they are mostly emerging markets and European equities. And included in the emerging market arena is Chinese equities. So they are the worst performing unit trust sector. And that is down to, well, two reasons really. The fear of Trump tariffs being put onto Chinese exports, but also because of a disappointment in the economic stimulus measures that were hoped for in China. They've not lived up to expectation, but tariffs are definitely taking their toll, the fear of them. And that's also why European equities are performing particularly poorly in this environment. Healthcare stocks, that is interesting actually, because they have started to underperform. They actually were performing quite well immediately after the US election result, but they've had a downturn, and that's because Trump is apparently going to be installing an anti-vaxxer as the US health secretary. So if that happens, obviously it's not great news for certain healthcare companies and pharmaceutical companies. But the UK equities, you can see there, haven't been performing particularly well. This is a lot to do with the fear of what Trump will do in terms of trade tariffs. So you can see that in the aftermath of the US election, what Trump says and the fear of what he might do is what's driving markets. Now, if we jump back to 2016, can we learn anything from what happened then? And now, if you look at what I'm showing you on screen, it's a heat map, the best performing sectors in the immediate aftermath of the US election. So I'm looking at the first 2 weeks roughly again. So the same period we've had since this election, so 2 weeks, roughly the same period of time. The best performers were, yes, North American smaller companies, just like they are in 2024. Back in 2016, healthcare stocks were actually performing pretty well because there was hope of reforms in that particular sector that could benefit US healthcare companies. There was also financials doing well again for that hope of deregulation. Tech stocks were top performers, and we also saw global stocks doing particularly well. Now, the question is that in 2024, given what we've seen so far since the US election, will that continue or will it start to fade? Now, looking at the data from 2016, again, that's a sample of one. But if we look at the performance of assets all the way up to the inauguration date, which was the 20th of January 2017, then they followed the same pattern as what we'd already seen in the weeks just after the 2016 election, which would suggest that we probably could see the same thing happen again. And in fact, those assets that had performed the strongest in the first couple of weeks after the US election result in 2016 continued to perform well, added to their gains, and were the top performers when we got to the inauguration date and when Trump was sworn in. And if we look at the worst performers, then it was a similar pattern, that the worst performers after the first couple of weeks of the election result continue to be the worst performers right up until the point that Trump took office. And in that instance, back in 2016, that was obviously mostly emerging market assets. So we had things like Chinese equities, Latin American equities, and generally global emerging market funds, and obviously Indian equities are part of that. So the message is that if this time around matches what happened in 2016, then what we've seen in the first couple of weeks after the US election result could well continue right up until Trump is sworn into office in the new year. Now, I've just looked at the general asset classes, but the Trump trade is not even. So if you go back to 2016, you can drill down into the equity sectors within the S&P 500, for example, and there were clear winners and losers. The winners were financials, for the reasons I've already stated, and that's because of that deregulation. And some of the losers were things like utilities, the things that were steadily defensive, perhaps boring, almost more bond-like. Whereas if you go to 2024, there's a similar pattern. We've got financials doing very well, consumer discretionary, and energy doing particularly well. And if you go to the other end of the scale, defensive sectors like consumer staples and real estate are relatively underperforming. It was the same back in 2016. Now, a couple of differences I want to point out. I've already mentioned healthcare isn't doing as well after this election result compared to how it was doing in 2016. That's because of the slight differences in what Trump is promising compared to back in 2016. But also, you can look at things like materials, things that would benefit from infrastructure spending. They aren't doing as well this time around because it's not been part of Trump's promises as they were in 2016. But consumer discretionary has been a top performing sector this time around, more so than back in 2016. And that is because Tesla is in that particular sector. And if you have been watching markets, Tesla's share price has been surging because of those close ties with Trump and Elon Musk, effectively almost performing part of his government. So there is a difference between the Trump trade sector performances, slight nuances compared to 2016, but there are still those similarities that are there. So the next question is, will the Trump trade fade beyond the inauguration date? So what will happen over the full 4 years of his second term in office? Now, there's a chart on screen that I'm showing you, which is the US dollar index. And as I mentioned earlier in the podcast, if you get the direction of the US dollar right, you tend to get the direction of most asset classes right. And this chart is really interesting because the dollar surged in the immediate aftermath of Trump's election. And we saw headlines talking about the power of the dollar and how strong it was. And we even saw famous magazine covers showing a strong dollar, and then it was actually Time magazine that did that, and then it actually proceeded to collapse throughout 2017. And as you can see on the chart, if you're not watching the video and you're seeing it on Spotify, if you're not actually watching the video, I can describe it to you for those who listen to the podcast, but the dollar collapsed all the way through 2017 into 2018. And that was because Trump struggled to get through the tax reforms and the healthcare reforms that he'd promised in his election campaign. And so that was called the Trump slump, and it therefore had an impact on asset classes. And so we saw things like US equities start to underperform slightly. We saw other areas that benefit from a weaker dollar, commodities, they started to perform very well. So we could see that again. And some people might point to the fact that, well, they thought they'd read that not only did Trump win the US presidency in 2024, but also the Republicans have taken control of Congress. That's the House of Representatives and the Senate. Well, actually, that's trifecta, what they call it. That was achieved back in 2016 as well. So Trump doesn't have a stronger mandate in 2024 than he did in 2016. As it stands currently, it looks like he will have probably a slightly weaker mandate because his majority in the House of Representatives and the Senate is going to be probably the lowest of the last 6 presidents. That's since Bill Clinton. So while he does have that trifecta, he does seemingly control the US government, it doesn't guarantee that he will have his own way when it comes to policy implementation. So what I'm saying is there is that potential of a Trump slump this time around because things are similar to what happened in 2016. So it's something to bear in mind. So moving beyond the US dollar, how did other asset classes perform during Trump's first term in office? Now, I looked at unit trust sectors again, and these numbers I analysed in pounds and pence. So it takes into account currency moves. Now, you might sit there and think the best performing sector probably across all 4 years was US equities, smaller companies. Well, it was actually the third best performing sector of all of them. I actually analysed over 30 of them. The best performing was technology stocks. But what will surprise most people is that the second best performing sector across all of them, and we're talking about all of the sectors including things like financials, global stocks, emerging markets, bonds, you name it. The second best performing asset class was Chinese equities. And a lot of people would have probably thought that would have been at the bottom because of all the Trump trade tariffs and the war of words with the other superpower in the world. But in fact, what this goes to show is that as the Trump's presidency continued, then other macro factors started to have a big impact in how asset classes perform. So it's not just down to Trump. There is a bigger world than Trump out there. And what happened during Trump's first presidency, I mean, we can't forget, is the pandemic. So the pandemic had a huge impact into the outcome of which were the best and worst performing asset classes. Now, Chinese equities fared better during that initial part of the pandemic. They recovered more quickly. And then there was hope once we got a vaccine that China was going to reopen. And so there was a lot of optimism, and that actually collapsed when we went into Biden's presidency. And actually Chinese equities then went into a significant slump, and US equities then started to outperform Chinese equities. But if you look at just that window of Trump's first presidency, then Chinese equities actually did very well. So if we did a quiz on this, then I don't think many people would have picked that particular sector. Of course, I've got to mention Bitcoin, although I'm not going to labour the point. Bitcoin has surged since Trump's election win in 2024. It's up over 40%. Now, that's partly because obviously Donald Trump is rumoured to be in the process of perhaps buying into an exchange and obviously deregulation. So it's been very positive for crypto at the moment. But there aren't many learnings you can take if you go back to 2016, because actually Bitcoin didn't do particularly well in the early days of Trump's presidency, but it surged far more than it is now towards the end of it. And that is probably just more of a reflection of the asset class itself. Now, if you look across all of the sectors that I analysed for those 4 years, then the performance table is almost a list from the lowest risk asset going up to the highest risk assets, which were the top performers. So the more risk you took, the better you were rewarded during Trump's presidency. And the bond sectors were towards the bottom end. And that was because we started to see, obviously, some economic growth and the prospect of inflationary pressures, but also because 4 years is a sizable time frame. And so what you will start to see is that if you extend a time frame, then other factors come into play, not just the volatility that you see within a couple of weeks after an election result. And the other thing, as a general rule of thumb, it seems to be that before Trump comes to office, the Trump trade seems to be based purely around what he says. But then once he comes to office, it becomes about what he actually achieves and does. And that seemed to have a big influence on the asset performance throughout his time in office. One thing I would say to point out is that if you looked at the best and worst performing sectors, the worst performing sectors in US equity markets by a mile was actually energy. Now, Trump is a president who is well known for being basically a global warming almost denier and favours fossil fuels and isn't particularly keen on green energy and innovation in that particular sector. Yet energy was the worst performing sector because the rest of the world actually embraced spending on green energy through his tenure in office, the first time he was in office. So what it goes to show is that Trump does have a huge impact on markets, particularly before he actually takes office. But then there comes a period where the rest of the world still matters, what the rest of the world is doing. Black swan events still matter. And it's the same with any presidency. If you have a financial crisis, for example, then that will have a huge impact on the winners and losers. So there you go, Andy, a quick roundup of what's likely to happen with the Trump trade. Don't bank on it going as it has already started. And if you want to know more information, then of course you could take out a free trial of 80/20 Investor and see the numbers drilled down and have a bit more insight into those winners and losers.
Okay, so let's move on to the next piece of the podcast then. We're going to be talking about pensions because leading up to the budget, there was talk of changes to the amount of tax-free cash you could take, and people started raiding their pensions. Well, of course, we now know that changes didn't come about. And so, Damien, there's lots of questions that people have with regards to what to do with this tax-free cash that they've drawn out. Can they put it back in their pension, for example? You've got the answers.
Yeah, so this came about because, as you say, Andy, there were a lot of people that started to withdraw their tax-free cash from their pension, fearing there was going to be a cap on the amount of tax-free cash that they could take as a result of that autumn budget. And as you say, there was nothing actually announced. And it means there are some people who have made some significant withdrawals that are wondering, well, what to do with that money and would rather have it back in their pension to grow tax-free. And so I've received correspondence from people, and I know of people who have said that they did this ahead of the budget. Now, this is a very good example of not trying to preempt something that you don't know about. So I think there's a warning to other people to not take action just because of speculation about what could be in a budget. Of course, if things had come out one way where they had reduced the tax-free cash, they would have won. But there are a number of people now that have made changes to their pensions, and it means that they has an impact going forward. So the first thing to say to those people who are saying, well, can I just put it back? Now, the answer is no, not without any kind of impact and possibly taxation. So the first thing to say, if you have taken the tax-free cash from your pension because of the budget, now some providers will have a window in which you can decide to undo a decision, a calling off period. Now, I've looked around and there are some pension providers that have up to 30 days calling off. So that means there could be some people still within that period, given that the budget occurred at the very end of October. So assuming you're no longer in your calling off period, there may be people who sit there and think, well, I only took the tax-free cash, the 25% that I was allowed. So I haven't triggered the money purchase annual allowance, which is the limit that restricts the amount you can put back into pensions if you start to draw benefits in excess of that 25% tax-free cash. But even if you haven't triggered the money purchase annual allowance, you have to be mindful of something called pension recycling. Now, fortunately, Andy, we did a podcast a few weeks ago on pension recycling and explaining the rules. So that podcast episode was 473. So make sure you go back and listen to that for the full rules and explanation. But in simple terms, the pension recycling rules were put in place to stop people taking lump sums from their pensions that would be tax-free and then trying to put them back into pensions to gain tax relief. So that excess tax relief, the HMRC doesn't want that to happen. And so they put in rules that are quite strict and very clear to limit the ability to do that. And if you fall foul of those rules, you could be hit with a tax charge of up to 70%. Now, I'm not going to go through it in details, but this the highlights that if HMRC believes that the pension contributions were part of a pre-planned recycling strategy, you could face those tax charges. Now, when they look at the pension contributions you make, they look at the contributions made in the 2 years before the current tax year when you took the tax-free cash and 2 afterwards. That can be a 5-year window. If you've taken £7,500 or more in tax-free cash in the last 12 months, so that's in total, and your total contributions have increased by 30% or more, and the pension contributions equate to 30% or more of the tax-free cash that was taken, you may trigger the pension recycling rules, and that can ultimately lead to a tax penalty. As I say, that can be as much as 70%. So go and seek advice if you are somebody who has drawn out that tax-free cash or draw money from your pension and you're thinking about wanting to try and put something back in. Do make sure you seek advice because you don't want to fall foul of those rules. Now, having said all of that, what else could you do? Well, of course, you could use the money that you've taken out for other means. You could gift it to people. You could, in fact, invest it yourself. You could put it in things like stocks and shares ISA, so it could grow tax-free. You won't get any tax relief on the way in. Of course, you could contribute to other people's pensions. So you could put money in for your spouse or your children. So even if they don't earn money, you could put up to £2,880 a year into a pension and they will still get that basic tax relief, taking it up to £3,600. So they are all possibilities. And as I mentioned there, gifting for inheritance tax purposes has become a little bit more attractive because pensions are due to be liable to inheritance tax from April 2027. So I think we are going to see more people withdrawing money from their pensions and giving it away if they are particularly worried about inheritance tax. So there you go, Andy, a very quick warning and roundup for those people who took money from their pensions ahead of that budget of what they can and can't do.
Okay, so let's move on to the final piece of the podcast then. Now, this week we saw an update to the energy price cap, which is the average a dual fuel household will pay a year for their energy. Now, every quarter this is updated by Ofgem, the energy regulators, and news this week of a 1.2% rise that's going to be in place from the 1st of January next year. So I just want to put some of these figures into context for people. We bring this to the podcast approximately every quarter when we hear these new numbers so that we can explain what the numbers mean, what the forecasts are, and whether, again, for those that haven't yet fixed, whether now is a good time to fix. So let's dig into the numbers then. What are we currently paying under the energy price cap? So from the 1st of October, through to the 31st of December. That is the current period we're in. The off-gem energy price cap figure is £1,717. Now, that's an annual dual fuel figure for an average household. Now, there was a 10% rise leading up into October. So we have seen energy prices rise from the summer and into the start of the autumn and winter months. And so we've been waiting with bated breath as to what the new announcement would be for the 1st of January, because of course it's still going to be cold. Our winter bills are still going to be coming through. So people were hoping that it wouldn't go up too much. And luckily, I mean, we say luckily, but some people will still be unhappy with the fact that it has gone up slightly by 1.2%. And that equates to roughly £21 over the year. And if you actually want to dig into the numbers in any more detail, we've done a news article which we've put on the Money to the Masses website. And in that article, we explain exactly how that works out in terms of the kilowatt hours that you'll pay for your gas and your electricity. But to make it really simple for you, essentially for every £100 you pay in your energy, in your gas and electricity, it's going to go up by around about £1.20 per month. Looking back then on how that compares to this time last year, because what you can do is you can actually look at your budgets last year, look at how much you paid last year, and I'm now going to tell you how much less you'll be paying this year, because that is the good news from all this. You are going to be paying less than you did last winter. And so that energy price cap set in January 2024, so last year, was at £1,928 for the average dual fuel household. The new figures going into January 2025 are set at £1,738. So the good news out of all this is you're actually going to be paying 10% less than you did last winter. So go back over your budgets, look at how much you paid last winter, take 10% off, and that's where you'll be for this winter. So while it is bad news that energy prices are creeping up, we are still better off than we were last year. And actually, if you look back a further year, that's where energy prices were their absolute peak. I mean, we were paying approaching £4,000 for the average dual fuel energy household bill. So it begs the question whether now is still a good time to fix, because of course, many people have already fixed, but there are many, many people that haven't yet fixed. It's now too late. Well, the good news is it isn't. There are plenty of deals out there. And we have actually got a really good article on the Money to the Masses website, which was updated today, in fact. So as we record this, that's Friday. And it looks at all the latest energy deals on the market. And all of the ones that are featured in there are cheaper than the current energy price cap. And when I say current, it's the 1st of October through to the 31st of December, that energy price cap figure. So even if you fix now, you will still be fixing at a lower price than the energy price cap is. And deciding whether you should fix going forward, well, you've got to take a few things into consideration. Obviously, when you fix, you're locking in a price. The problem with that is that you are locking it in. And so if energy prices significantly fall in the future, you'll be locked in at that higher price, and people who didn't fix might be getting a better deal. But whereas in the past, with fixing your energy deal, you were often locked into the deal, which would mean sometimes you'd have to pay to get out of that deal, there are deals available now where you don't have to pay an exit fee. So typical exit fees for a dual fuel bill will be around about £50 or £100. Do shop around. The article that we shared on the Money to the Masses website, we'll link to it in the show notes. There are a few providers out there that will allow you to fix with their deal and exit their deal without paying an exit fee. So it's definitely worth shopping around.
So that is a brilliant roundup there, Andy, of the energy situation. And as Andy pointed out, the question is now that we don't know what's going to happen with energy prices going forward. The geopolitical situation is something to bear in mind, but you are able to get a deal that ensures that you are fixing your energy, that it isn't going to rise. And we're not in an environment where people are predicting that it's going to fall significantly. So in a world of rising prices, rising mortgage rates, I think it will still be attractive to a lot of people to consider fixing their energy bills. So that is it for this week on the show. As ever, do please leave us a review. I will be reading them out in the near future, and then we'll be giving away some Money to the Masses mugs. Do follow us on all our social channels. Do please go onto our YouTube channel, subscribe and share our content. It's really helping us gain new followers and subscribers. So please do go on there and support us. Also, Instagram, TikTok, we're putting out new and unique content on there that we don't bring to the podcast. So if you enjoy the podcast, you'll definitely be enjoying what we're doing on social media. And also join our Facebook group, facebook.com .com/groups/money to the masses. So that means that all there is to say, Andy, is until next time.
Until next time.